Hello, friends. Good afternoon. This is Mindie Molina, and you're listening to the Mindie Molina Show. Thank you so much for joining us. And I have Frank Borelli in the studio with me today. Say hello, Frank.
Hello, Frank.
We have been talking about various different types of retirement accounts, and specifically for business owners, maybe small business owners or growing business owners. Obviously, retirement accounts for big corporations are pretty standardized at this point. You have your 401ks, and we understand those concepts. And when I talk about different retirement accounts, sometimes it's so encompassing because there's so many different terms or labels that it can get confusing. So for example, you have your 401ks, your 403bs, your solo 401ks, your SEP IRAs, simple IRAs, Roth IRAs. They're 457, and it can all get a little bit confusing. So if I said to you, Frank, what is a vehicle? Like not an investment vehicle, but just like a vehicle in general, how would you describe a vehicle? What does it do? What is it?
A vehicle would be something that gets you from point A to point B.
Yeah. Okay.
That's a mode of transportation.
It is a vehicle is going to get you from point A to point B. So at the end of the day, all vehicles are designed for one purpose, to get you
One place to another.
Right. It's a form of transportation to get you from one place to the other.
I think we're talking about money though today, right?
We are, but I have a point. So the reason I'm saying this, because just like vehicles, there's so many different types of vehicles. Okay. In my mind, I'm thinking of a vehicle right now.
VW.
What kind of vehicle do you think I'm thinking of?
A bug. VW.
A VW bug. I am thinking of a car, but it wasn't a VW bug. So, but there's like all these different varieties of cars that we could be thinking of. Could be a truck, could be an SUV, could be, a
Typically
convertible.
designed for specific purposes.
But at the end of the day, they are all designed for the same purpose.
Point A to point B.
To get you from point A to point B. So now let's take this scenario. We all understand vehicles for the most part, I'm sure. And these retirement accounts, 401ks, 403bs, 457s, SEP IRAs, simple IRAs, solo 401ks, these accounts are all designed for the same purpose, okay, to defer taxation, income tax, right? So the whole point of them is to get you from point A to point B, to get you from your working years into your retirement years without paying taxes on the money that you are saving.
Or on its growth.
Or on its growth. So tax defer. That is the purpose of these accounts. To defer, meaning to put off. Until later, pay the taxes, right?
Not right now. Not this year.
So now do you understand why I was talking about vehicles? They're all they're the same. They're designed to do the same thing. It's just that they have different little features. And choosing the right vehicle for you that fits your family, your lifestyle, your needs is the same as choosing a retirement account, type of a retirement account for you, for your business, for your employees, for your needs. So it's at the end of the day, the whole point of these accounts is to save money on taxes and to allow these investment accounts to grow without, essentially tax-free for a while. Why is that important? Because of compounding. Okay, when you can deposit money into an account and you don't have to pay, and you're probably in a higher tax bracket in your working years. It's typically
for middle America, that's generally the case.
Yeah, exactly. Typically, you're going to be in a lower tax bracket once you retire. So by deferring or putting off paying your income tax on this money until you're retired, the idea is that you're going to pay the taxes at a lower rate. That's the whole point. We want you to make the most off of your money. We don't want Uncle Sam or other people making money off of your money. We want you to be the one. So if I said, who's making the most money off of your money? The answer needs to be
me.
Yeah.
Or you.
Exactly.
Whichever case. Now, the government incentivizes these, that's why these are in the code, in the Internal Revenue Code.
Yes. What, elaborate.
So-
What do you mean by
Well, I'm
incentivizes?
saying, yeah, that these plans exist, and the objective of the plans is to defer your income tax now, and so that hopefully, as you stated, that I can be in a lower tax bracket in my retirement, so that I can defer those taxes, as you said,
Yes.
to a lower rate in the future while they compounded. But the incentive, the government helped these plans be put into existence because Americans weren't saving enough money.
Oh, yes. Okay. Yeah. So that's the point. Yes. They're the incentive. What the incentive is to save on taxes. Why?
Save.
Because they want you to save for retirement. Why? Because you really need to.
They
The
don't
government
want
doesn't
people
want to
on
have to pay for you.
Medicaid. Yeah.
Exactly. So yeah, correct. So let's get into today. What we really want to talk about is how these different account types, what the features are that make them different, so that you can think about. Especially if you're a business owner, this is going to be a really good, a good lesson for you to understand the different opportunities that you have. I'm sure that everybody just went through their taxes and their planning, and now they know what they should have done last year, because that's
Hopefully, if they had a good account, or if they had a strategy in reviewing their taxes, or had someone help them sit down with a review of what that looked like. Some people just happy they got it over with, and they relied on TurboTax.
we put off. Well, what happens sometimes is even if the CPA says, "Hey, you should get a solo 401k," people put it off, and next thing you know, the year's over. Why? Because taxes are not your expertise, right? Investments are not your expertise. You're doing your job, and especially business owners. I can relate. I'm a business owner. It's stressful.
We're self-employed, right?
Yeah, you're self-employed. You are. You're kind of wearing a lot of different hats, and you're doing your job.
So busy, an entrepreneur.
But
in many cases.
That's why we are here, to make it very simple for you to, number one, understand, and then second of all, implement, right? If you don't take action, we want to take the work out of implementing it for you. And implementing, thank you, Frank.
This is a live
yes, please.
program. Please feel free to call in with any questions or stories you'd like to share about your investing, retirement planning scenarios, or any questions you have about retirement accounts. You can reach us at 772-221-1100. This is the Mindie Molina Show at 772-221-1100. You can find us also at mindiemolina.com. That's Mindie, M-I-N-D-I-E.
Mindie, M-I-N-D-I-E. YouTube. You can Google my name and you'll find us there. And if you do, leave a review. We always are looking for those.
Just good ones.
I never say that. And yeah, I think we only get good ones. So, okay, let's talk about these accounts, right? So the whole point is, imagine that, let's say your business brought in $500,000 and now you're in the highest tax bracket, and what we're wanting to do is peel off some of that money that you are going to be saving for future years and not pay your taxes on it right now. So how do we do that? Your CPA can certainly help you in deciding what type of accounts that you need. What we like to do is to work and discuss with your CPA what they suggest that you do, and work hand in hand with them. We're always open to communicating with your CPA, but most importantly, helping you implement these accounts, because the truth is, it's very simple. It's very easy to open the account, and it's very easy to fund it, and you have a lot of control when it comes to those. It's just a matter of taking the time to make the phone call, go on our website, like Frank said, mindiemolina.com. You can call us here at the station, 772-221-1100. First thing we're going to talk about.
They could set up a meeting for us to come to their conference room, or come to our conference room if it's even a body of believers.
Yes, absolutely. And let's start with the solo 401k. And I'm going to start with that one because a solo, I'm going to go based off employees, right? So first we're going to talk about the solo 401k. Why?
Sometimes called a one participant 401k.
Yes.
401k. By the code.
By the code. Frank was not satisfied with the term solo 401k because he couldn't find it in his book.
You know, I had a cup on my desk that my soldiers gave to me in the office. I was the quality control office at one point in my career.
Yes.
And they had inscribed on my metal cup, "What's your reference?"
Mm-hmm.
Because in the military and aviation, when you're,
I'm not
everybody
surprised.
has all these wonderful ideas of what they want to do with the helicopter and how they're going to do it. You know, we have to have specific instructions on how you might
Yes.
work on a piece of equipment that leaves the ground.
So this slang word, solo 401k, was not acceptable to Frank because it was not in the instructions, in the instruction manual that he's been studying. So he just went onto the IRS website and confirmed a solo 401k actually does exist. It's just referred to as a
One participant 401k.
There we go. So now we're on. There's my reference.
Yes, ma'am.
So the solo 401k. This is an amazing tool for an account type for self-employed individuals who don't have employees. Okay, so no employees.
Could be their spouse.
Yeah, typically it's you and a spouse, and it can be your spouse. So you, if you're married, you and your spouse, or just you, but no employees. Okay, this solo 401k is going to allow you to very, very easily, because 401ks actually come with a lot of red tape. There's a lot of red tape. Yeah, a lot of red tape that goes in.
Oversight. Make sure
Yeah.
it's done correctly.
And one of the reasons that businesses don't offer them is because they're expensive to offer and they're a lot to manage. So this is a very easy way for you to, and cheap way, right? It's not expensive.
Because of the technology age that we're living in, that it's really made it. You know, it would only be big institutions. Is what you're saying. We've come to the time.
Yeah.
You know, we've modernized so much, and the computer age is upon us so heavily that there's people out there offering these programs that it's not very expensive, a lot less expensive than you would think.
The solo 401k serves this purpose. It is going to allow you, even though you are a small business that perhaps doesn't, just because you're a small business with few employees or no employees doesn't mean that you're not making money. So you're making all this money. Now, what do you do with it to avoid this heavy taxation because you're getting thrown into that higher tax bracket? Well, the answer is a solo 401k, because now you can set up the solo 401k, and it becomes your own personal 401k that is set up through your company with your own EIN number. So it's set up through your company. It becomes completely tax deductible. So the money that you put into that account,
Tax deferred.
well, you're deducting it from your taxes that year. The contributions that you make become tax deductible, and then the money that you put into the tax account is tax deferred. So this tax strategy is protecting you from, it's allowing you to defer those taxes, and most importantly, it's protecting that money from that higher tax bracket that you're in right now while you're still working. And it's allowing you to create your own 401k, which is amazing because now you have the ability to compound. You're able to invest and make money on money that you actually owe Uncle Sam. So eventually, Uncle Sam is going to want his cut of that money, and that's what's called a required minimum distribution, which happens further down the road in your 70s. But right now we're talking about your working years and how to establish a good tax strategy by using a solo 401k. Now remember, a solo 401k is for people who do not have employees.
No employee.
Husbands and wives can be included, but that's it. It's really designed for you. Now, the contribution, the limits are the same. You have up to $66,000 a year as in a solo 401k. It opens that whole employer. See, there's a difference between the employer and the employee. So when we're talking about these accounts, you have to think about, am I thinking about this as the person that owns the business, or am I thinking about this as the person that works for the business? So right now, the solo 401k doesn't even apply to someone who works for the business. It only applies to the people that own the business. And in that case, you are able to put up to $66,000 into the account in 1 year, which is a huge amount of money. If you go back to that $500,000 scenario, you know, that you were thrown into that higher tax bracket. What is the highest tax taxation? Do you know, Frank, off the top of your head? It's like 32% or something. It's a lot, okay? It is a lot. 37%. And so you're able to, again, protect that money from that higher tax bracket and create your own retirement account that you can later utilize when you are retired. And when you're taking that money in retirement, when you're taking those distributions, your taxation is probably going to be much lower, more in the 20s or even less, depending on what you're receiving. But it's definitely an amazing strategy, and it will help you with your tax savings, your tax burden for the year. You can also, if you are over the age of 50, so something that, some terminology I want you to be familiar with is called the catch-up. Tell them what the catch-up is.
Yeah. So if you're age 50 or older, they're going to allow you to additionally contribute $7,500. $7,500 can be additionally added into your 401k.
Yes. So that's called a catch-up. So people that have waited a little too long to start these accounts and now they're in their 50s and they're saying to themselves, oh boy, I don't have enough money to retire. Or now they're actually saving a lot more money because they don't have the expenses that they used to have in their 30s and 40s. Yeah, exactly.
Off the college.
They can dump some more money into these accounts that we can't until you turn 50. So it's a great opportunity to get more money. So that bumps it up to $73,500 if you're over 50. That is the solo 401k. Again, for people that own a business that are self-employed with no employees.
Also could be called a unit K, evidently by the IRS, or a one participant K, and like you said, solo 401k or solo K. And
something else to think about, is you might have employees that you think are employees, but they're actually, if you're giving them a 1099, those are considered contractors. Those are not considered employees in this instance. So you would not have to. That wouldn't count. You would still qualify for the solo 401k.
Yes,
so 1099, if your employees are all 1099, then you would still qualify for those solo 401k, you and your spouse. So, again, this is a live show. It's the Mindie Molina show. You can go to our website, mindiemolina.com. You can Google my name. You can watch our show and all of our tutorials on YouTube and learn as much as you can about retirement planning. And you can also schedule a time to sit with us if you'd like.
What's
you
the
go to our website.
Coming and sit with Mindie Molina Investments and Insurance.
There's no charge. There's never a charge for that. And all consultations are complimentary. And so let's talk about now
holistic.
A simple IRA. Simple. Actually, no. Let's talk about the SEP.
SEP first, because SEP has simple in the title.
Well, it does. There's this. That's why this is confusing, and it's why we're talking about it today. So there's a reason why I want to talk about the SEP second. Why? Because the solo 401k that we just spoke about is when you have no employees. And maybe you have 1099 employees, but no W-2 employees. Okay? Then the SEP, I want to talk about it next because it's a little special. And I'm not so certain that it is a good fit if you have a lot of employees. But let's say you do have an employee. Maybe your son or daughter work for you. Maybe you have someone who's been working for you for years, but that is almost like a partner, but they are not owners of the business. But we have, there's so many businesses out there, people that are self-employed that have businesses who have really special, employees that work for them that they want to reward. A SEP can be a great opportunity for that.
For any size business.
Excuse me.
It's an IRA.
It is an IRA. Same concept.
Traditional.
Trying to protect you from those high tax consequences when you get into a higher tax bracket as a business owner. So deferring the taxes, not having to pay the higher tax on the income, being able to have it.
Well, you hope it's not going to be
contributions. You want your contributions to be tax deductible. Okay, so a SEP IRA. The reason that I say it's a little bit special and that the employees have to be pretty special is this. If I'm the business owner, So let's say Frank and I. So I set up a SEP for my practice, for my firm, and I want to put $50,000 into my SEP this year.
For Frank.
In order for me to put $50,000 into my account, I have to also contribute the same portion for him,
See?
for Frank. So if I,
Good
and
idea, man.
it is prorated. Yeah, it is. It's like you can't be better to yourself in the SEP IRA than you are to your employees.
As the employee. The employer
As
has
the-
to treat the employee the same way.
Yeah, they have to match their, I won't call it a match. They have to have the equal contribution. So if I'm putting in 30% of my income into my SEP IRA, meaning I'm swiping that 30% away, I have to also contribute 30% of whatever Frank's salary is into his SEP IRA. And employees cannot contribute. This money only comes from the
Up to
employer.
25. Up to
Em-
40.
We're back. Okay, it cannot be more than 25% of your salary, correct? Thank you for that. And it again goes up to that same limit of 66,000.
All right.
And
Easy to set up and operate.
it's very easy. You're not going through like you are with a regular 401k. This SEP IRA is doesn't come with a lot of red tape, and your advisor can set it up for you. But there are certain restrictions. One of them is like I said, whatever you contribute, whatever portion of your income is being contributed into that SEP, you have to do the same for all of your employees. Even if any employee that makes $750, right? So if you have, someone coming and helping you here and there, but they have reportable income of $750 or more, you have to set up the SEP IRA and make the same contribution on their behalf. So if you're maxing it out for everyone and it's 25%, you have to do it for everyone. And that's where it kind of can drive away some business owners. So it has to be that your group is a tight-knit group, because here's another catch. They are immediately vested. So the money that you are putting in, and remember, they have no skin in the game. The employee, the person working for the company can't even contribute to this account. Only the owner of the company can contribute to a SEP IRA. So the company is paying for these retirement accounts, which could be a really good benefit for someone. Let's say someone who is retired, but now is doing another job, like Frank, who Frank's already retired from the military and gets his pension from that, but now he's has come into this field, and he could possibly be a good candidate for a SEP IRA because may want to just start banking the money. He might not necessarily be relying on as much of the money at this point in his life for income as he is for future savings. So if you're in a relationship like that with one of your employees or all of your employees, and the two of you are saying, hey, we all need to get ready for retirement, a SEP IRA is actually a great opportunity for you to save on income taxes, all of you, but you have to look at it as like a team effort.
Sure.
Yeah, because it's an all or nothing kind of thing. And there has to be a level of trust there, because the money that you're giving them up front, you could reduce the salary, you could make adjustments on what's affordable, but think about it, if you have an employee that you're giving them a large amount, you're maxing out 25% of their income is going into their SEP IRA because you're trying to help them retire, they're vested right away. That money belongs to them.
We mentioned that it's a simplified employee pension. That's what SEP stands for. Simplified Employee Pension. Simplified Employee Pension.
Exactly, yeah. It's like, I always wanted to be called the self-employed something, because that's what makes sense to me.
Yeah,
like,
right.
why is it not the
SE,
self-employed
self-employed
pension?
IRA.
Doesn't that make more sense? No. Well, the government doesn't like to do things that make sense.
The IRS also says that you can't take loans from these, and you can't use them as collateral either. There are some cons to
Yeah, some of the,
participant loans not permitted. The assets
as you
cannot
would be
used
able
as
to in like
collateral.
a 401k.
You
Yes.
have in-service withdrawals, but included in income and subject to a 10% additional tax if under age 59 and a half.
So, anything else that I'm not remembering about the SEP IRA that I wanted to mention? Okay, just like a regular IRA, they're subject to the 10% rule penalty. Did you just say that?
I did.
Oh, good. Okay. that just reiterating what Frank said. So you can, the penalty is when you're under 59 and a half, and that's going to apply to the majority of your retirement accounts. Is there any that it doesn't apply to? Yeah.
Well, there's some exceptions.
There's exceptions, but as a rule of thumb on vehicles, like, for example, if we said vehicles take you from point A to point B using fuel, you have to buy gas for them or diesel. There are some exceptions, right? Because some now we have electric cars. But anyways, there isn't this 10% penalty is pretty standard, so it's important that you understand what it is. Right. If you set up a retirement account, and this is why I always tell people, people come in, it's like, oh, let's set up a Roth. Well, you have to have an emergency fund. You have to have enough money set aside, because if you come in and you set up a retirement account and it's exposing you to this 10% penalty, you're locked into that until you're 59 and a half. And if you try to take your money back out, guess what? They're going to keep 10% of it. The government is going to penalize you 10%.
So if you're not concerned about taxes, potentially a strategy for you, if you need to be liquid and you may want to set up an opportunity fund with these extra money that you would consider putting into a 401k, but you might have an opportunity to make an investment somewhere that you might like, then it might make more sense to put it into a taxable brokerage account and grow it in a different manner in a taxable account.
Yes, a retirement account is not for every person, but it certainly can help you if you're in that position where you're growing your business.
How are you going to prepare for your retirement? What income are you providing in your retirement? Right? That's why we have retirement planning. There's
also one thing is that you can't convert. There's no Roth version of the SEP IRA. So a lot of accounts we're going to get into what a Roth is, however, but that's not an option. You don't have to have employees.
Which would eliminate the problem potentially for the employer if they didn't have that much profit or extra capital to put into the other employees' plans. If you're a single, solo employer,
yeah, you would just
self-employed,
none of those other things would necessarily matter. So, summary of the SEP IRA. Some of the things that we covered. One, this is if you are self-employed and you have employees. Two, at the percentage amount, whatever portion of your pay that you're going to put into your account has to be the same portion for all of your employees that make $850 or $750 or more. And then also the business owner is the only one that can make the contribution. So the employees themselves cannot contribute from their paycheck to this account. That's not what a SEP is designed to do. It's really just for the employer to provide a benefit for you.
It was has worked for the employer. The employee has to have worked for the employer in at least 3 of the last 5 years.
So now, again, Mindie Molina Show. You can call us if you'd like, 772-221-1100. You can also go on our website at mindiemolina.com. And we are talking about various different types of retirement accounts. We've talked about the solo 401k, and that is very useful for business owners, self-employed individuals who do not have employees. And then we just spoke about the SEP, S-E-P, the Simplified Employee Pension. Is that what you called it? So then, and how if you have employees, you really need this is better if you have a really tight-knit group or you're